Hey, Steve Saretsky here. As always, King Real Estate Market Update with a particular focus on Vancouver. You can sort of value or entertainment out of these videos. All I ask you, hit thumbs up and subscribe. Questions, comments, put those below. We got a good show here. Last one in Maui. I really want to touch on some additional commentary, which I just discussed in the most recent episode of the Looney Hour. Again, I highly encourage you to go check that out on Spotify and Apple Podcasts. But I want to provide some additional commentary to that because we talked about sort of the latest inflation. Is there a case for some deflation as well? But we just had U.S. CPI here come out this week at 6.2%. The highest year-over-year reading in over 30 years, right? So inflation is growing at 6.2%. It turns out inflation, it wasn't transitory. It's sticking around much longer than we anticipated, and so. Now I look at the Fed, the U.S. Federal Reserve, which is really the most important central bank, right? You can pretty much forget what the Bank of Canada is talking about. It's fun to sort of tease them, but at the end of the day, what the central bank that matters is the U.S. Federal Reserve, because they are the world's global reserve currency, and they provide liquidity to global markets. So what happens is basically if the U.S. Federal Reserve starts tapering and hiking interest rates, that ultimately strengthens the U.S. dollar and basically crushes global markets, particularly emerging markets suffer the brunt of that because what happens is you have a rising U.S. dollar. Most of these emerging markets are borrowing debt in U.S. dollars, so that debt becomes then more expensive to repay, etc. But anyways, so you got U.S. CPI inflation running at 6.2%, which is kind of a prelude to where Canada is going to come in here in the next couple weeks. Now everyone's saying, well, the Fed, surely, we're talking about taper. The Fed surely must raise interest rates, right? 6.2% inflation, obviously running above and beyond their target. But they're stuck in a very difficult position because, as we know, the U.S. Debt position is not great. It's not a whole lot better than where Canada is. And, we just had a situation where how much of this inflation is due to global supply chains, right? You shut down the economy. Now you're going to try to restart the economy. So demand never really suffered, but you had all these companies basically cutting inventory and trying to restart. And that's pretty difficult to do with global supply chains. So it's much easier to shut down the economy than it is to reopen. So the question ultimately becomes is, can the Fed, by hiking interest rates, fix global supply chains? And the answer to that is quite simply no. Now, people are basically arguing through rate hikes is that the Fed should basically hike interest rates, kill demand, induce a recession, and that will basically alleviate the price growth. So the sort of dilemma here, or the scenario, is do you pick the recession or do you pick the higher inflation? And, as we can see here, the picture actually gets even more complicated. This report just came out that a record of 4.4 million Americans just quit their job in September, based on everybody wanting, job wage increases. So the labor market is still recovering. It's there's a lot of people still out of work. You've got everyone calling it the Great Resignation because you've got these vaccine mandates coupled with people wanting higher wages, that you've got all these people leaving the labor force. So it's a really sticky situation for the Fed. And I think Canada is actually in, again, a very similar boat. So I think the prognosis is this starting to look a lot like the 1940s, where inflation was very high and the Federal Reserve never reacted. And so we can see here in the 1940s, what happened was you're just coming back post World War II, and you had these massive debt burdens, obviously, to fund the war. And so in order to sort of alleviate those debt burdens, what they did is they basically suppressed interest rates. They were engaged in a massive quantitative easing program back in the 1940s. And they let inflation run hot. And in periods, actually, the real interest rates went as deep as negative 19%. And so, at least as of right now, that we're following the same textbook where the Fed isn't flinching. And again, maybe they will. Maybe they'll opt to induce that recession. But as of right now, I think if you're trying to alleviate a a debt problem, if you're trying to alleviate a debt to GDP, it makes sense to try to inflate away that debt. So we're going to watch that very closely. But again, I think this is important to understand because if I can sort of explain one thing, is you have to watch the Fed and the BOC will ultimately follow. In fact, some interesting comments here from the Bank of Canada. Ignore the date on this is November 7th, 2021. So let's clip to Tiff Macklem's comments right here.
The term that economists keep using is this, don't worry, folks, this is transitory. Okay. It was transitory a little while back, and it's persistent. And now the bank's even saying it's going to persist longer than we thought. Maybe that's the wrong word. What's a better word to describe what's going on than transitory?
I'll take that on board. I think transitory to economists means sort of not permanent. Right. I think to a lot of people, transitory means it's going to be over quickly. And maybe, I don't know exactly what the right word is, but it's probably something like, transitory but not short-lived. And what can I be more precise about that? Well, a week ago, we put out a new economic projection for Canada. And we do have inflation. It's running 4.5% now. We think it's going to go up to close to 5%. And then over the course of next year, we think as we get to around the end of next year, it's going to be around 2%. So that's what we mean by transitory but not short-lived.
Okay, but in June 2020, you were saying, hey, I'm more worried about deflation than inflation. Now we're at 5% inflation. I guess the question is, are you in control? If inflation is global supply chains, global COVID issues, tensions with China, there's a lot of juggling balls that everyone in this building and you are trying to figure out. So people say, well, boy, the governor seems confident, but is the governor in control?
There's no question. We've never been through a pandemic before like this. We've never closed an economy. We've never reopened an economy. The good news is we are reopening the economy. The economy has come a long way back, and now we're facing a lot of the challenges of reopening an economy. We've said for all along it's going to be choppy, it's going to be bumpy, and it is. But are we in control? Yes, we're in control. We have the tools. We are using them. Last week, we took some important steps to adjust our monetary settings, and we're going to continue to adjust our monetary settings. And the goal here is to secure that complete recovery and bring inflation back to target.
So notice that they're now sort of walking back. First it was like, hey, we're going to have deflation, and we've got a little bit of inflation. Then it's okay, don't worry, it's transitory. It's turning out to be more transitory. Now we're getting inflation is actually good for you. And we're seeing a bunch more of those headlines now. And I always say, like, to frame up that video, you say, like, man, like, what is the central bank, the Bank of Canada's governor doing on mainstream media news? Like, this is all just a scripted act. It's all sort of kabuki theater, basically, where the questions are pre-scripted. Like, you have to ask yourself, why am I watching this, and why am I being played this video or this interview right now? Why is CTV News bringing on the Bank of Canada's governor? It's all messaging, right? It's like, hey, listen, we're going to get out of inflation. We're here. They're here to trying to explain to people, to sort of make a rationale as to, why they're keeping rates where they're at, and maybe why their transitory call has been wrong. And so I really would ultimately say that, I think, people are essentially being lied to, right? I mean, as the Bank of Canada governor, you can't say, hey, listen, guys, we've got a debt to GDP problem. Our country is massively over indebted. We've got a housing bubble. So what we're going to do is we're going to let inflation run hot here. We're going to run real negative interest rates, negative by negative 4, 5, 6, 7% for the next decade to try to alleviate that problem. You can't come out and say that. So they have to say, hey, listen, we're going to sort of fight inflation. But again, what can the Bank of Canada do to solve global supply chain issues? There's nothing they can do. And hiking interest rates is only going to induce that recession, which, again, given Canada's debt burden, doesn't seem like a very healthy thing to want to digest, at least from a policymaker's perspective, because you have to imagine that at the end of the day, again, the Bank of Canada is funding the federal government, and to suggest that they are independent again, is a complete misnomer. The Bank of Canada is essentially directly funding the federal government through what is called modern monetary theory. As we've talked about in the show, since the second quarter of 2019, the Bank of Canada has funded roughly 89% of the federal budget deficit. So, that's where we are. So basically if I can kind of pass through something here, I think we're entering, again, very volatile times as markets try to figure out how central banks are going to react to non-transitory inflation that is being largely induced through supply chains. But now you have, employees or labor that is now demanding higher wages to offset for the rising cost of living. And so, not only do we see that in the most recent U.S. jobs report, which I just highlighted, 4.4 million Americans quitting their job in September. But not only that, but you also have, look at what's happening with a company called Cargill. Cargill in Canada is set to go. They're the largest meat producer in Canada. So they actually they process 40% of all beef in Canada. 40%, and so everybody's well aware that beef costs in Canada are up exponentially over the past year. I think that, don't quote me on this, but I believe beef prices are up about 25% in Canada. Now you have the largest beef producer in Canada is now saying that as of December 6th that they're going to be going on strike because they're demanding higher wages. And so you can only see where this is going. So it's either Cargill employees get higher wages, which probably feeds through to higher beef prices, or they go on strike and the supply of meat obviously gets constrained and restricted on top of what it already is. And so either way, you're looking at, again, higher beef prices, higher food prices. And so this is ultimately going to weigh on Canadians and likely on consumption moving forward, because at the end of the day, inflation is just a tax. And if the cost of inflation and food and all that is going up 5-6% a year, that's just a tax. And unless your incomes are keeping up with that, then net you're actually getting poor. And so if there's one thing I can get you to take home from this video, whether that's you investing in hard assets or assets are going to help you offset the rising cost of living, the second alternative would be to, at a minimum, negotiating with your employer for higher wages, because at the end of the day, unless in Canada here, inflation running at 5%, which is probably underreported, unless you're getting a wage increase or growth of at least 5%, net you are getting poor. And so I think that this is things to watch, and I don't think the market has figured out the normal reaction function of central banks here would be to normalize or raise interest rate policy and curb demand. But I think when you overlay the supply chain issues, the amount of people quitting work, I don't see how normalizing interest rate policy and stoking a recession is going to improve the overall position for the overall populace. And I think that's one thing that the markets are trying to figure out. Nobody's looking back at the 1940s and saying maybe they can pull this off. And again, I don't think it's going to be pulled off with ease. I think that's probably what they have to do, whether you like it or not. But I think there's going to be some very obvious winners and losers in society. And, I said it on the podcast, but it's very hard, unfortunately, to be optimistic on the lower middle class in Canada. It really is. So anyways, we'll watch this with fascination, but like I said, focus on what's happening first and foremost in the US, and you can see that Canada is in a very precarious situation. So as always, see you next week.